MC? All right,
Yeah.
so let's then start.
I'm gonna mute myself just so I don't have any disturbance from my end as well. So
Yeah, thanks, Renu. So let's begin. I think in today's session, the focus is really to understand like how you can use some data-driven approaches to select mutual funds. As anyone who is invested in Indian markets, we would know that there are about 2,500 mutual fund schemes available for any individual investors. So in this session, the idea is to give you some framework which you can use and cut down from this 2,500 number to a number which is uh, which is manageable. Like you can analyze to a number which is manageable. So with that in background, I'll start. Just like our previous session, if you do it on laptop, it'll be good. Take notes. As I was telling you before, if you have any questions, you can write them in chat. And yeah, just try and put a focus for next hour or so in this session, and then hopefully, uh, my understanding is you if when you walk out of it, you'll have a very decent framework which you can uh, use and then apply this while selecting mutual funds for yourself or your family members. So before I begin, a bit of a legal disclaimer: I'm not a financial advisor, so don't treat any of this that you're seeing on screen as financial advice. Use this as a starting point to begin your research, or use this framework and see how you can apply this in your own personal context. But again, just wanted to call out that. Now, individually for me, I'm actually a late starter on mutual funds. I started in 2008 actually as a cash market trader. I used to had some sort of pocket money in 2008, and then I used to trade stocks to see if I could make living out of it. Obviously, the plan did not work out, so I made another bigger hedge. I started speculating in future and options, and I did it for a couple of years. Again, the results were not that great. Then slowly from 2013, I actually changed from a cash market trader to an investor in direct equity. And that is where I actually found that yes, if you approach equity markets as an investor, you actually can really make decent returns. And from 2013 onwards, I've seen that happening to my own personal portfolio. And after COVID is where I actually started on mutual funds. So personally, for me, I was a very late starter on mutual funds. Only after 2020, I started doing mutual funds. Now, my reasons and why it took me so long was that, as I was saying, 2030 onwards, as I was doing direct equity investing, I actually had success in direct investing. So I never bothered about looking at mutual funds. Again, I also have very similar problems when I wanted to start on mutual funds, that I thought there are too many funds. Most of them look same with no differentiation. How will I pick which funds to invest and which funds to ignore? So that was also a problem for me. The third one was, at least at that point of time, 2012, 2013, there was lack of any single brokerage platform where you can go and actually buy all mutual fund schemes. So that was another problem as such. But before we go into selecting mutual funds and talking about which mutual funds to select, one of the things that I've been big proponent is, why select mutual funds? You can just basically do index investing, invest in Nifty 50, indexed in Nifty 150, Nifty 250, and just continue with your life as is. Because if you look at data, right, and I've just given you a chart on the slide, which is from US and UK. So the research is from the UK, but it's on the US market. As you can see in this, over long term, right, over 15 years, almost 90 to 90, 95 to 98% of funds actually don't beat a normal broad-based index. So why bother about selecting mutual funds? You can just continue to do ETF or index investing, and then not worry about selecting mutual funds. The reason is, I'll give you a couple of bullet points later in the slide. India is slightly different. So before I go and discuss about the Indian framework, if you want to learn more about ETF investing, we did a webinar last month on this. There will be a link in this pack. You can go and actually look through it. So you looked at the US data. Now I started looking at the Indian data, and what I found was that in India, actually beating broad index is happening for many, many years. The reason could be this is a nascent market, a new market. Our total market cap is not as big as United States or some of the other developing countries. Also, we have far more companies which are currently operating in unorganized sectors, and the recent movement from unorganized to organized has only started in the last 15, 20 years. So I've looked at data. India is actually an exception to rule. On the left hand side, you see um, this is a chart where active what the active funds made every year, and this is from 1995 to 2017, and then uh, in the middle you've got the total returns that people made from the Nifty, and as you can see, the average return there was a very huge difference, right? The active funds were able to get 23% average returns, while the Nifty only delivered 12.5%. So definitely a lot of active funds uh, actually made more returns than Nifty. So actually investing in active funds made sense in India. So this is from 2017. I also looked at data, which you'll see in the next chart. This is from 2023, so recently finished calendar year. And if you look at this chart, right, a number of large cap funds which were actively managed actually they managed to beat the index. The index returns were about 20-23%. But if you look at the top performer, which was the Nippon Large Cap Fund, it actually made 33%, so 10% higher than the index. So clearly, there is a case of doing active investment in Indian markets. So if someone from West is coming and telling you that just do ETF investing, just do index investing, that may not be yet true for India. It might become true 15, 20 years down the line, but I think currently there is enough opportunity and scope in Indian market to really do active investment. So with that case settled, let's look at how would you go about actually in selecting mutual funds. Uh, as I was telling you, right, I was reluctant to invest in mutual funds, but there were three key reasons for me which actually changed my mind. Uh, it is a very tax efficient structure. I found out that anyone who is making a salary income or is making an investment income from housing, mutual fund is actually a tax efficient structure because you only have one tax event when you are actually selling out. So unlike equities where you can continuously switch in and switch out, with mutual funds, the switch in and switch outs actually don't cost you. There is only one tax event, so they are very good tax efficient structure. The other thing is a lot of these mutual fund managers are actually very very experienced in the investment management field. So you are actually employing the best minds in that space. The third thing is as life happens, a lot of times you find that you become time poor. Active direct equity investment, at least for me, was very time consuming. So I wanted to go a little bit of passive by actually employing some of these mutual fund managers to look after my money. So those were the three key reasons that actually pushed me towards the mutual funds. Now, as I was telling, the main problem with mutual funds is the number of schemes. This data is from a fortnight or maybe a month back. There are 44 AMCs or Association of Mutual Funds in India and MFIs, and together they offer about 2,500 mutual fund schemes. Now, humanly, it may not be possible. With AI, yeah, maybe we should be able to do some dicing and slicing, but humanly, it's not possible to analyze 2,500 mutual fund schemes. So definitely, you will need a framework which you can use. So this was the question that I also had in 2020: is what sort of framework I should build that if I have done the work once or twice, I should be able to leverage that work and really select schemes which then I can build my portfolio and my family's portfolio around. So with that, I would like you to introduce to a win framework. Now, How did I come with this framework? This is very similar to the framework that I actually built for investing in direct equity. So what I mean by that is when I was starting investing in direct equity in 2013, I looked at the options that if I have to approach direct equity investments, what should I do to make meaningful returns as an active investor? And then I went about in history and understood who have done really well in direct equity investments and chose two or three frameworks which suited my personality. So similarly for mutual funds in 2020, right, the key question that I wanted to understand was what works in investing. So I'll give you some examples, right? The what works in investing is basically you're looking at strategies that have stood the test of the time. So for 30, 40, 50 years, those strategies have worked in investing. So they have got clear academic research as well as some practical implementation in the wide varieties of market. So this WIN framework is basically understanding that strategies, uh, using these strategies, then you do a search of are there any mutual funds which meet these strategies. And once your search is done, then you use some of simple, uh, I would say, selection criterias to then select the mutual funds and then go ahead and invest in them. So uh, in this session, my focus would be to actually to really focus on the strategies. I'll also run you through an example of how you can practically pick a strategy, implement in a search, and then from the search, how do you arrive at the select. So keep this framework in the mind as we go through the next 15-20 minutes to look at what strategies would lead to search and what search would lead to selection. Now, what works in investing? So for this, I actually looked into some academic research first. And one thing is very, very clear academically. So I'll share some examples as well in this slide, right? So I looked at one key theme that you will find is that smaller companies have generally would give you more returns over a long period of time. So if you are consistently able to find smaller companies, then your average returns will be better than the market. So in 2015, Tweedy Brown, which is a US based investment manager, they did a research. And obviously, I'll give you the link to the paper here. But if you look at that chart, they divided all the companies in US into five quintiles, and the smallest quintile, which is quintile five, actually gave the maximum return. So in one of I've extracted the table, which you can see on the right hand side, is that value of $1 invested in the smallest company actually grew to $524 between 1926 to 1980. Against that, the largest company only made $108. So the compounding was highest for the smallest companies. And they've gone through more details in their research. Obviously, they've looked at other factors, but my focus was on what research they have done on the smaller companies. If you look at some of the Indian data, right, and this is the last 5 years data, which you can see on the left hand side, 149 companies which made 3 to 4x were small cap. Similarly, if you look at companies that have become five times, 73 companies have become five times, which were small cap. Only 10 companies have become five times their value in which were mid cap. There was no large company which went five times in their market value. So clearly, if you are a smaller company and if there is a manager who can pick smaller companies well consistently, then that's one of the strategies that we have to keep in mind that smaller companies have done well. And I'll have a link to this pack, which will have all the source information that you can go to and read in detail uh, a little bit more. So that will be that we will mark as our strategy number one, which is smaller companies have done well, and we will use this strategy to see if we can actually build a mutual fund selection framework using this principle or using this strategy. Now, the second strategy that I wanted to talk about was momentum. There is a lot of academic research already done in this investing space where momentum, if people follow momentum strategy, it really leads to a very positive or alpha outcomes as far as their portfolio is concerned. For anyone who like wants to understand, momentum is basically uh, something that has worked over last 12, last 6, or last 3 months. The momentum strategy says that over the next 3, 6, or 12 months, the stock will continue to do well. The momentum strategy is is a very simple strategy. People think that how can something which is so simple, where you just look up the past performance of stocks over a period of time and then predict um, that they will continue to do well. It has actually fascinated so many academic folks in this space that I think there are at least 15, 20 papers that have been done on the momentum. The most interesting paper is actually from Jagdish and Tilkman. This paper was published in 2011. Clearly, they indicated that if momentum strategy is used, which is between 3 and 12 months, that strategy will really do substantial they will do substantially better than the normal market. So that paper was published in 2011, and there has been several other studies done after 2011 as well. If people are interested to really understand an Indian study, I've also posted a link in the back to an Indian research paper which was done in 2015, where they looked at implementing the same strategy but for Indian markets, because Jagdish's paper and Tickman's paper were looking at uh, holistically at the US market. So we looked at the second strategy. So first strategy we picked up was the small companies do well. Second strategy is momentum works in investing. Now let's look at the third strategy. The third strategy, and that this is where I actually started in direct equity, was looking for companies that exhibit value and quality from a numerical perspective. Like looking at the company's number, you can judge that it's a quality company, and then looking at their price, you can clearly make out that it's a value buy at that particular price. So any fundamental philosophy which works on value and quality, what I found in investing is that actually is a deadly combination. And we don't have to look any further, but the biggest proponents of this strategy has been Warren Buffett and Charlie Munger, right, who have run this philosophy for their company for 50 years successfully in US. Like anyone who has invested in them with them in Berkshire Hathaway, uh, I've just taken out some stat, right? Like if you put 30, if you have put 40 years back in 1965, $1,000 in Berkshire Hathaway, that has now become 36 million in by 2022. So clearly, this strategy works. I've also looked at the some academic research on this as well. There is a paper by AQR Capital. The paper is called Facts, Fiction, and Value Investing. And in the paper, I've taken one quote for you, but obviously you'll have a link to the paper if you want to read. It clearly says that profitability or quality measures can be used to improve value investing and shall be consistent with a risk-based explanation for value, which means that if people have really invested and looked at value and quality parameters, then they can definitely get higher risk-based returns. There's also another paper that was published in Australian Journal of Studies. In that paper, the author looked at if all the stocks are divided into various quintiles, the value quintile actually gave an adjusted alpha of 6.37% over the market. So they done this rigorous analysis. Again, link to that paper is available. You guys can go and have a look at that post the presentation. So this again paper was done in 2013. and that was the third strategy. So we looked at broadly, these are the three strategies which I want to use, and then use these strategies as bedrock to see if I can select mutual funds using one of these three strategies. So first one is small companies do well. Second one is momentum investing. And the third one is value plus quality. So let's now look at how we can use one after another, all these three strategies, and put them into our framework to see if we can actually select mutual funds using that. So I hope I'm not going that fast. So I'm going to go next, but obviously you'll have a chance to actually ask me questions at the end. So the search criteria that I used was there has to be a strategic fit. I need to ensure that the three strategies that I've selected, they are matched before I select a mutual fund. I also look at some of the other factors. The mutual fund needs to have a long-term track record. There is management continuity with the scheme that I'm going to invest, and obviously I don't want to pay very high, exorbitant fees. So the fees have to be reasonable. So nothing out of ordinary. Very simple search criteria that I'm going to apply on the universe of mutual funds and come up with. Actually, that helped me in coming up with this small selection of funds, which today I'm invested in. So look at first thing. So we will look at of the win framework, right? What works in investing? We will look at first the momentum factor. Now, the issue which I found with momentum was that there was no easy way to select momentum based mutual funds in India. So the only way I could do is I went to Grow's website and just used the keyword momentum and typed and see how many mutual funds are going to come up. So when I typed the word momentum, I got about 15 results. But the other thing was most of these results were actually ETFs. So the NSE would have a momentum index, and then AMCs have created products which just match these indexes. So there was no active momentum mutual fund which I could really find. So what I did was I took the three of the biggest funds. They could be ETFs, they could be active, and then I started analyzing them. So when I did that, I found that most of the funds, as you can see on the screens, they were actually index funds. There were no active momentum funds. I found only two mutual funds which were really following active momentum. The first one was the Quant Momentum Fund, and the other one was Samco Active Momentum Fund. I also found that in Indian markets, there is no long history for momentum funds, right? This screen is taken from Value Research website, and as I can see, the latest uh, return information that we have is only 3 years back, when I think the UTI Nifty 200 Momentum ETF was launched. So, with such a little performance information available in public domain, there is not really a big uh, actually makes it a very difficult decision there. So you to actually select something. So you have to probably follow these two active funds, which is the Quant Momentum and the Samco Active Momentum Fund, and see how they do over a 5 or a 10 year period. But at the moment, if you want to approach momentum investing through mutual funds in India, there is not much option. There, a couple of funds have been launched, but they don't have very long track record to manage. So at the moment, you actually can't wait. The only other option is you look at the ETF funds, but then ETFs, what I found is they are usually slow to react. So you would actually want active management. So for that, I'm not going to pick up anything like UTI or Tata Nifty or Mirai Asset Nifty. I will rather focus on two of these active funds and see if they continue to do well, then one of them could become a shortlist candidate for me. So that's on momentum strategy. Currently in the Indian market, there is not much that you can find using this strategy in the mutual fund space. The next that I looked at was searching the what works in investing in small companies. So in this, there is a lot of options available. So what we are looking at, small cap funds. Small cap funds are the funds which invest in small companies based on the guidelines given by SEBI. And what I did was I wanted to do a long-term performance ranking, 10 years, 5 years, and 3 years of all the small cap funds that are currently available for investors. So I've given a couple of links in on the slide. You can use any of the links uh, to really go and create your own performance ranking measures. What I like is do a 10-year, 5-year, and a 3-year performance benchmark. And I'll show you a snapshot in the next slide on how that looks like. So I this the simple thing is here, first thing is you just do ranks. So you take rank 1 to rank 10, just write in a piece of paper on spreadsheet if you are tech savvy, just write the funds which have gone from rank 1 to rank 10 in terms of performance. The next thing that you should do is if any fund has made the 10-year, 5-year, and the 3-year list, you mark them in green. So in our slide, the example is like the Nippon India Small Cap Fund or the Quant Small Cap Fund. They made top 10 in each of these time frames. They made it in 10-year time frame, they made it in 5-year time frame, they made it in 3-year time frames. The second thing that you do is you also highlight anyone who made it 2 times. So something like Franklin India Small Cap Fund. It was in the top 10 in the 10-year time frame, and it's also there in the 3-year time frame. The other thing that you would like to see is the ranking ascending. If the rankings are ascending, that means every as you get to the nearer time frame, the fund has started doing even better. So that this green and orange then becomes my part of research. So if I have 3 or 4 funds in green, I generally don't look at the orange, and definitely I'm not looking at the blank, the white ones, because they were one time under and they made ranking, or they are new funds and they were only able to make ranking once in these time frames. Now this is my framework. You can choose 20 years, 15 years, whatever works for you, but I wanted to look at 10, 5-year, and 3-year. The second thing that I wanted to look at is of the green funds, which I took was Nippon, Quant, and HSBC small cap. Have they beat the index? Because if they have not beat the index in the 10, 5, or 3-year time frames, then I'm better off just in putting my money in the ETF. So what I did was I plotted these 3 funds against the index. So in the next slide, you can see that I've plotted this 3 funds. And if you can see the arrows, right, the index is basically the green line. So each of these funds have actually done better than the index. What I've also looked at is the brown line, which is the category average. Each of them have also done better than the category average. So that becomes my second filter. So I have first filter is the ranking. Second filter is have they beaten the index. If they have consistently beaten index, which is over 10 years, 5 years, 15 years, then that means that they are doing good job of allocating money to smaller companies. Then, once this is done, then you can actually drill down and look at a comparison. So, as I was telling you before, you look at the expense ratio, how much you have to pay to use these funds. They're very similar in these three. So 0.64, 0.64, 0.65, nothing much to choose from. The other thing that I look at is I look at the fund size. The reason being, if the fund size is small, generally it's preferable for me. That's my personal preferences, because I don't want a large fund size, because generally I find that large funds tend to move slow. They can react only slowly. So my preference is not to go with very small funds, like something which is of a 1,000 or 2,000 crore fund size, but I would also don't want something which is 50,000, 40,000, 70,000 crore. fund size. So I typically look for smaller fund size, small to medium fund size. So in this case, if I was reviewing this strategy, then probably the Nippon small cap fund would be a bit of a red flag for me because it's already a big fund with 50,000 crore, but it might be different for you. So that those are the things that I look at. As I was saying, the other things that you would look at is who is managing these funds. So you do a little bit of research on the guys. You will know that each of them are having finance background. They've been most of them have been, uh, especially like Sanjeev, who is managing the quant fund. He's got 17 years experience. So nothing, no red flags. You can also see if there is any fraud connected to these guys. Generally, you'll not find that. But yeah, good to do some bit of a Google search on the fund manager who is managing that money. So that just using this framework, we've understood the strategy was small companies. We wrote a filter, we did ranking, compared it to benchmark, look at some of the key criteria, and now we have a short list of three companies. And then we can do a little bit of more digging and select one or two or all three of them because all three of them have done really well over long term. Then, as I was telling you previously about this ascending steps, right? So what I have done is last month I took a snapshot of how these three funds have performed over 10 years, 7 years, 5 years, up until year to date. And you will see a pattern, right? That slowly I've given a green star to every time uh, they have won. So the way to read this line is in 10 years, the winner was Nippon India with 25.67. And in 7 years, the winner was Quant. So as you see, the leadership has slightly changed, right? It was Nippon. And then in the medium time frames, it has gone to Quant. And then in the very recent time frames, 1 month and 3 months, the leadership is changing to the HSBC. This could be also a function of size, right? The Nippon is the highest size fund, and then Quant Small Cap is medium, and then HSBC is the smaller of the three. So the return, as you can see, the leadership is slightly changing. Whether this will remain same or not same, I don't know. But that is also something that you should review. One option, if people don't want to do too much of thinking, then they can just pick these three and say that okay, one third of my money in this strategy is going to go to these three, and then I will only review in 3, 4, 5 years time on how they are doing. So that's a complete process where you have picked up a strategy, you ran a screen, you did ranking, you compared it to benchmark, you reviewed the fund's information, and then you selected a company. I think end to end, this should not take you more than 1 to 2 hours over a weekend on one particular strategy. So that's there. And then the third strategy. So we looked at momentum, we didn't find anything. We looked at small cap. We arrived at 3 to 6 funds. If you look at the oranges, you get even 6 funds. Then we looked at the third strategy. The third strategy was value and quality. Now, again, if you want to really find value plus quality sort of mix and try to search for mutual funds, again, you may not find much. Obviously, a lot of funds are called value funds, as you can see in the table below. So that's one option to look at this. My personal way to look at is generally great managers, great fund managers, they don't want to be boxed. So they don't want to run a large cap, small cap, medium cap. They want to run a fund where they can invest anywhere, wherever they want. So generally, the good place to look at would be these four, which I have highlighted on the screen, right? Which is multi-cap fund, flexi-cap fund, focused fund. Now, all of these fund types, right? Generally, you would you will see the fund manager going across market caps. They can buy large cap, and then they think the value has shifted to small cap. They will go to small cap, and each of them have done really well. The table shows the 10-year performances of these. The top performers in these funds have done like 22, 21, 20%, which is phenomenal. It is not as good as the small cap. As you can see in the table, the small cap, the top performer, which was the Nippon, has done 26% per annum for last 10 years, which is mind boggling. but even 22, 23, 21 is great numbers for people to focus. So then, as a proxy for value and quality, we will look at focus funds, flexi cap funds, or multi cap funds. The idea is very similar, right? You pick one category and then you run the exercise again. So what I did was I picked up the multi cap from the previous scheme, and then I repeated the same analysis of the top 10 funds in the 10-year, 5-year, and the 3-year time frames for the multi-cap universe. And I was surprised because the number of greens that popped up, which means that a lot of these funds have consistently done well. Tantamount to the fact that the fund manager has have been really good in keeping their rankings intact in the 10, 5, and the 3-year time frames. So so actually you've got seven funds. Yeah, seven funds which have actually made the 10-year, 5-year, and 3-year rankings. So our objective is very similar, right? You take these seven funds, and the next what you do is look at the benchmark. Then, if they've beaten the benchmark, then do a fund check of the size. Then you look at the uh, expense ratio. You looked at who is the fund manager, what history they have, and then from there you can make your selections in the value and quality category. So that's pretty much from my side in terms of the information pack today, right? So if you learned a little bit about this framework, then anyone who is on the call, what I would suggest is to run a homework, run this comparison analysis. Whatever we did for the small cap funds, do the similar for the funds. I'll share the pack, so you'll have the multi cap ranking done. So you can only start from the ranking sites, and then you also do this analysis for the flexi cap and the focus funds. We talked about those are three categories which I use as a proxy for value and quality, right? Multi cap, flexi cap, and focus funds. So with that, you will have 3 to 4 funds in small cap, 3 to 4 funds in multi cap, 2 to 3 funds in flex cap, and 2 to 3 funds in focus funds. And overall, you will have a very manageable set of 10 to 12 funds, which you can then do a deep dive and maybe select 3 or 4, which you want to use for your investment journey. So, uh, this is the hard work, right? So, if you do this exercise, and I'm telling you, for one strategy, it will take you less than 2 hours over a weekend. Once you have done that exercise yourself, you don't have to go to any fund manager, you don't have to rely, you don't have to ask anyone which scheme to invest. You have a framework, you use that framework and spend 2 to 3 hours, then it's time to chill. Generally, I recommend people that if you put a single dollar or a single rupee in mutual fund, that money should not go out from that mutual fund for at least 15 years. Do not invest anything in mutual funds for less than 15 years. If you need that money before 15 years, don't think about mutual fund, because sometimes because of the way the stock market cycles work, right? You may have a 7 or 8 year period where nothing is happening. You can look at the Indian stock market data from 2014 to 2018 or even late 2019. Nothing happened in the small cap space, and then boom, in next 3 to 4 years, these now the small caps are the flavor of the season. Like they have gone 50, 70, 80% over the top in last 3 4 years. So you have to give 15 years to a strategy. So once you've done the selection, leave it for 10 15 years. You've hedged your bets by selecting 2 to 3 funds in a strategy, not a single fund. And then you let the fund managers do their work and do their work. So that brings me to the end of the presentation. Most of you know me, so I'm not going to add anything here. But yeah, these are some of the social handles for you to reach out to me. There is a lot of content on my blog, so yeah, you can read through that. But best thing is you join the Telegram channel. All the latest things that we do is actually on the Telegram channel. So it's actually good to just join that. I will anyways have this pack ready for you guys.